We've brought together a stellar panel for you with key decision makers in the field of sustainability reporting. And let me just introduce the panel to you. First of all, we have Professor Kirsten Lopata. Kirsten is the Vice Chair of EFRAG Sustainability Reporting Board and the Professor of Accounting and Auditing and Sustainability at the University of Hamburg. Hello, Kirsten. And then we have Isabel Grauer-Gaynor. She's the Head of Corporate Finance and Reporting at ESMA, the European Securities Market Authority. Welcome, Isabel. We have Professor Jeff Hales, who is an ISSB board member and the former chair of the SASB Standards Board, and also a part-time professor at the University of Texas at Austin. Welcome, Jeff. And last but not least, Simon Braaksma, board member of EFRAG's Sustainability Reporting Board, also the chair of the Sustainability Reporting Working Group at the Dutch Standard Setter, and also a man of practice as Senior Director Group Sustainability at Royal Philips. So Simon, welcome. Welcome everyone. Let me briefly set the scene for this discussion. And as Peter said, we are going to focus on ESG and performance metrics today. And we have two leading initiatives at the moment that are making enormous progress. And that's internationally, the International Sustainability Standards Board. And at the European level, we have EFRAG and the European Commission working on standards. And that's what we want to cover today. Now, very briefly, the ISSB released two standards, final standards in June. And only very recently, already IOSCO, the International Organization of Securities Commissions, came out with an endorsement of these standards, asking regulators in some 130 countries to take action and to formulate an adoption strategy. I think these are this amazing progress that the ISSB has made. Similarly, in Europe, the European Commission is nearing completion of its 12 ESRS standards, as advised by EFRAG, and they will be mandatory ultimately for some 50,000 companies in Europe, starting from 2024 onwards for the large listed ones, and then others following later. And maybe also good to mention that the standards and the reporting that is taking place in Europe also has a requirement to be provided with assurance, limited assurance in the first instance and reasonable later. So there's a lot going on and a lot of progress been made in a very short space of time. So let's go on to our panelists and review where we stand at the moment and then dive into a discussion on will companies actually be able to report on what is required, what kind of implementation support would be needed in order to make this happen, and also come to the question, will these standards actually make a difference in the end? So let me maybe start with you, Jeff, if I may, at the international level. I mentioned the great progress that the ISSB has made in such a short space of time. Could you maybe expand a bit on what is actually required under the standards?
Sure. Yeah, thanks, Mark. So the way I think about this is that the ISSB didn't try to invent a set of standards from scratch, but in fact was trying to build off of the what we saw as the best, most relevant investor-oriented guidance that was out there. So the standards incorporate integrated reporting, the SASB standards, CDSB's guidance, and we also looked very closely to the recommendations within the Task Force on Climate-Related Financial Disclosures. So the idea was to be able to build disclosure standards that would be very investor-focused and that would cover the full range of sustainability-related risks and opportunities that companies face and that investors need information about when making investment decisions. So if I were to try to characterize at a high level what is in the standards, one of the easiest ways I think I would think about is the core recommendations under TCFD, where there are disclosure requirements for to talk about governance, risk management strategy, and metrics and targets related to climate-related risks and opportunities that companies face, including under the TCFD recommendations, Scope 1, Scope 2, greenhouse gases, and then if appropriate, Scope 3 under the TCFD recommendations. And then, of course, the SASB standards, those of you who are familiar with SASB standards, are industry focused. So there are 77 different industries. So what would be expected for disclosures under the SASB standards depends very much on the type of company that you are. Marc, you know this very well as a former SASB board member with me. But the typical industry had something like 5 to 7 disclosure topics and about 2 or 3 performance metrics for each of those disclosure topics. So if I think about what we've done in building S1 and S2, I would say we're expecting companies to do both TCFD and SASB, but go a bit further in some ways. That's really kind of how I think about it. So one way to think about it is S1 sets out the expectation that companies are going to provide material information about the sustainability-related risks and opportunities that they face. And what's important to remember there is that that's entity-specific. So in a sense, that goes beyond what SASB was trying to do, which was set out, from on an industry basis, what was reasonably likely to be a material topic. So this goes a bit further by being entity-specific. And then we don't expect companies, again, to disclose on all possible sustainability-related risks or opportunities, but we're focused very much with the investor lens on those that could be reasonably expected to affect the company's prospects, where we think of that as, its cash flows, access to finance, cost of capital over both the short, medium, and, of course, the long term as well. So, it's up to a company, in a sense, to decide what those to make the determination around what those sustainability-related risks and opportunities are. But when they do, that's where the TCFD architecture comes in, and we ask companies to then disclose around the governance of those sustainability-related risks and opportunities, what the company's strategy is when it comes to managing them, how it incorporates those factors into considerations into its risk management processes, and then to disclose metrics and targets. Now, in the absence of specific ISSB guidance to identify what the appropriate metrics would be, we ask companies to refer to and consider what's in the SASB standards, the disclosure topics, and then when deciding the appropriate information to disclose on these the risk and opportunities, to again look to the SASB standards. And they're also welcome to look at other sources of guidance when they've identified a risk or an opportunity, including they can look to information they've already gathered with respect to the European standards, the ESRSs, or GRI, if they feel like they've gathered information that's relevant to a risk or opportunity that they've identified as relevant to investors, they can use that information to disclose that. Just quickly on the climate side, climate is, in our S2 standard, this is the first standard where we've actually then unpacked on a topical basis what is in kind of embedded in S1. So if a company makes a determination that it has climate-related risks or opportunities, S2 is going to unpack that and help them to provide information on the risks and opportunities, but from a climate lens. So not just saying, tell us about the risks, but thinking about, are they physical risks? Are they transition risks? For example, thinking about a transition plan and climate resilience that is embedded into the company's strategy. We identify Scope 1, Scope 2, and Scope 3 emissions as being required. This is all subject to a materiality lens, again, but we provide guidance there that aligns with the Greenhouse Gas Protocol. And then there is also accompanying industry-based guidance that companies can look at to say, well, given the type of industry that you're in and the expectation that they would disclose industry-specific information, they can look to the industry-based guidance to help to identify the types of information that would be useful to investors there. So at a high level, you can again think of it as like bringing together SASB and TCFD, going a bit further in a lot of ways.
Yeah, well, thank you, Jeff. And I think I take it that it would still be a step up probably for quite some companies compared to where they are at present in their reporting. Which brings me then to Kirsten, and thank you, Jeff. That brings me to Kirsten, because in Europe we're not talking about 2 standards, but very soon to come 12 standards that companies have to report on. So maybe you can give a bit of a flavor of what is required under the European standards.
Yes, thank you so much, Marc, for the question. Well, we have, as you said, 12 standards. So we have ESRS 1 and 2, which are more general. So we call them cross-cutting standards. So ESRS 1 focuses on general requirements. ESRS 2 is more for general disclosures. Both will be mandatory. And then the rest, we have 5 E standards, including climate change. We have 4 S standards and 1 G standard. And they're all subject to the materiality assessment. In comparison, what Jeff just mentioned, we not only have the investor focus, so we usually say investor plus, so we include other stakeholders, and we of course focus in our structure is the TCFD that Jeff also mentioned already. So we start with governance, then strategy, and then we included our so-called IROs, so impact, risk, and opportunities. And then at the final stage, we are talking about metrics and targets. And as you ask for performance, of course, from my perspective, the reporting over these components then leads to a performance measurement, so to say, that the stakeholders can derive their own impacts and risk and opportunities from. So in saying that, what do we have especially here, for example, for climate change? So this is the E1, and as Jeff also mentioned, the ISSB already published the S2, which is also the climate standard. So for example, when we talk about metrics and targets, they should be reporting about manage relevant climate-related risk and opportunities. So that is, for example, a transition plan for climate change mitigation. And when we talk about these transition plans, we include, for example, the greenhouse gas emission reduction targets, and we also included decarbonization levers. What else can be here in the performance metrics? Well, climate-related targets to support climate change mitigation and also adaptation, and also to address climate-related impact, risk, and opportunities, as said already. And for example, also if you set your climate-related reduction targets, it should be disclosed for scope 1, 2, and 3 emissions. What is already disclosed, and I think that is also not a top-up, but maybe Simon can elaborate a little bit more on that, is the energy consumption and the energy mix overall. And we also ask for metrics of tons of CO2 equivalent and total greenhouse gas emissions. So that's my overview.
Thank you, Kirsten. And maybe I move to Simon then. I think from what I hear from you, Kirsten, and also from Jeff, that it as I said, it looks like it will be quite a step up for many companies in terms of what they have to report. And so the question to Simon is then, you are a standard setter, but you're also on the receiving end as a reporter, Simon. Do you think that companies will be able to report on all these requirements from 2024 in a high quality way? And also in a comparable way, what is your sense also from indeed, as I say, being on the preparer side?
Yeah. Now, maybe good for the audience to understand that the scope of the CSRD. So I'm focusing on the CSRD and the ESRS, so the European Sustainability Reporting Standards, and not so much on the ISSB standards. But the scope of the CSRD are 50,000 companies in Europe. And what I do think, and then there's a difference in timing. So companies that are listed, like Philips, my employer, they need to report over the year 2024. But that means that we need to start collecting data as of Jan 1st, 2024. My, guesstimate is that for about 1,000 companies in Europe, this will be an enormous effort, but they will manage. And then I'm focusing on the listed companies that already do have quite some experience with sustainability reporting. But I would say 49,000 companies in Europe, which are mainly, larger companies that are in scope of the CSRD as of the year 2025, will have extreme difficulties in meeting all the requirements. And let me try to underpin this a little bit. Speaking again from my own experience, and that is, I've been working for Philips for 25 years and the last 15 years in sustainability, where I'm responsible for our ESG disclosures. So I've been there for 15 years. We have published also an integrated report for 15 years. KPMG was our assurance provider a long time ago, when we also achieved reasonable assurance on all our ESG disclosures 11 years ago. So we've got 11 years of full assurance, reasonable assurance on all our ESG disclosures. What we also did, and many companies are doing that, and that's also a recommendation for those on the, in the session that have to do the work really, the preparers, I would say. We have done a gap assessment, and we hired a Big Four accounting firm that is quite familiar to Marc to do this gap assessment. And they came to the conclusion, after we did our double materiality assessment in a preliminary way, where we identified the material topics to Philips, which are 6. The climate action, circular economy, own workers, workers in the value chain, consumers and end users, and the governance standards. So 6 topical standards are material to Philips, according to our double materiality assessment. And KPMG and ourselves came to the conclusion that we need to report on 950 data points. Yeah, and we're a big company, but there are companies that even have more standards that are material to them. But 950 is a lot, and smaller companies will not have maybe that number, but they easily arrive at 600, data points that they need to report on. We then had that same advisor doing a gap assessment and basically assess whether we today meet the requirements, partially meet or not meet. And with 15 years experience and reasonable assurance on everything, we meet the requirements in 30% of the disclosure requirements, so the data points, partially meet 19%, and not meet 51%. So we have a TCFD report, GRI reporting and everything. So I would call myself very experienced and very mature. And then you come to this specific position. So if you then ask me, Marc, do you think that those other 49,000 plus companies will be able to report as of 2024 or 2025 in a good and complete and qualitative way? The answer is no. It will be a huge challenge. And I don't say that it's wrong to set these timelines, but you should also manage the expectations. You need to start somewhere, but it's very ambitious. And especially for smaller companies, the number of disclosure requirements and the fact that there needs to be assurance on it, which I fully support, is an extra dimension. And getting the data is one, but on having then also your control frameworks in order and everything else is a big challenge. For listed companies, I'm quite okay, but for the not listed companies, I've got serious concerns that as of year 1, they will be in a good shape.
Thank you, Simon. And that brings me then to Isabel. Isabel, as a regulator, if you listen to this, well, Simon makes a distinction between listed companies and non-listed companies, and I assume the first in scope for you are the listed companies. But are you worried about the quality of implementation given the short timeframes and the volume of disclosure requirements, and maybe also the fact that some of these metrics that need to be reported are not that well established, right? If I think about biodiversity or some other areas where that may be relatively new to companies. So what is the regulator's perspective on this, Isabel?
I think that's a good question. I certainly hear it from Simon, but also from others that there's no doubt it's a steep uphill to climb. And I think with a number of challenges, but I think for a number of stakeholders, I mean, also, obviously preparers or issuers. And yes, as you mentioned, my scope is more listed entities, but also for assurance providers and for us regulators. I am going to say it this way. I do want to be cautiously optimistic. But first, maybe allow me to reflect on maybe a helpful way, perhaps, of thinking about implementation is to consider that there are 2 interrelated levels of implementation. The first one relates to the Corporate Sustainability Reporting Directive, which sets out the main obligations relating to the materiality approach, so double materiality for the EU, the reporting perimeter, including the value chains and consolidation, the reporting areas and the sustainability topics, the treatment of third country companies, and the responsibility or responsibilities of the administrative and control bodies within the organizations. So for me, these are all aspects that can and should trigger strategic and organizational decisions within companies, and that as soon as possible, if not done already, starting now. Now, I think as Simon mentioned, some of the largest companies, which already are subject to the NFRD, have already had those conversations, have already engaged in a lot of work to address these issues. And as I just said, it's important for those who haven't started that conversation to start doing so. And I'm thinking, for example, of organizational decisions on the infrastructure that will support the data flows from subsidiaries to parent companies on sustainability reporting, or the decisions on whether and how to centralize both the financial and the sustainability reporting responsibilities under the same chief or hat within the company. And those decisions can be actually taken sooner than later, and probably need to be taken sooner than later. Now, the second level here is then the specific reporting requirements, which are set out in the delegated act. So these have reached the market in their final shape recently, but EFRAG's advice to the Commission at the end of last year already provided a good preview of what could be expected. So the Commission's delegated act has introduced, compared to EFRAG's advice, significantly more leeway for companies to comply with those new requirements. And with longer timelines. So hopefully that will help also implementation. In terms of challenges, I think an important aspect to consider when you think about implementation quality and speed is also the availability of the necessary expertise. While part of that necessary expertise can be acquired by what we're also seeing, which is reconverting existing accounting experts that are available in-house into sustainability reporting experts, it would also be necessary to source external professionals that have a skill set that covers the social and the environmental areas. And I think this is actually quite key for any successful and timely implementation of the new requirements. Another possible challenge, I think, that you've mentioned is the availability of data and the resulting degree of uncertainty that it may introduce, especially in the first years. So I think, given the rather broad set of the phase-in provisions, we do have an expectation that the required disclosures will be in place on time to meet the reporting deadlines. This will somewhat be facilitated by some proportionality provisions that are included in the ESRS. For instance, there's the undue cost and effort provision for certain estimates, most notably in relation to value chain information and certain estimation of anticipated financial effects. I think what's most important is to be transparent about the source of information and certainty, especially with respect to forward-looking information. The ESRS emphasised the importance of faithful representation, which also refers to the accuracy of the information. For me, in this respect, estimates should be presented with a clear emphasis on their possible limitations and associated uncertainty, and that's here where we're in a journey, right? So that they will get better also over time. So as I started saying, I think I'm cautiously optimistic that the implementation can happen in an orderly way and lead to a good level of disclosure quality already in the first years. And I think the limited assurance obligations will certainly give a strong stimulus to companies to reach the first reporting season with a reasonable level of preparation, and the expectations and scrutiny from market participants, but also from NGOs, will also be a strong incentive.
Yeah, thanks, Isabella. You mentioned assurance, so let me maybe link something on that. But if we look at so recently there was the consultation by the European Commission before they actually finalized their standards, and in the responses that the accountancy profession gave to that consultation, they all alluded to some concerns and saying, okay, well, because, and actually what Simon was saying, because the challenges that there is a risk of poor implementation in the beginning, and therefore also consequently a risk that there will be many modified assurance reports in the beginning, because you talk about, from 24 onwards, in Europe at least, auditors will need to give limited assurance reports. But modified reports is obviously something that in a financial reporting world immediately cause red flags and causes concerns. So how do you look at that, Isabel? I maybe start with you and also ask Simon and others if they want to come in. But so how can we manage that? Because I think technically, that's what accountants need to do. They will be asked actually to also flag where things are less than perfect or not fully in compliance with the standards. On the other hand, are market participants actually ready for such a signal? Right, that's the question. So Isabel, maybe I ask questions first to you.
Okay, thank you. So as you know, in the various lines of defence, we're sort of last. So there's first the corporate governance, and then there's the auditors, and then there's all the assurance providers, and then there's us. So let me start with what we do and how we consider usually audit reports. So right now we're in the process of developing our guidelines on the supervision of sustainability information as is required by the CSRD. And the approach that we're taking to develop those guidelines is to mirror as much as possible the existing guidelines that we have on the supervision of financial information, which were established first in 2014. And as you know, we have a wide breadth of experience in enforcing IFRSs or accounting more generally, which obviously we do not have in sustainability reporting. So it's a useful comparative exercise to make sure that as a supervisory community, we have the same level of ambition between sustainability and financial reporting in terms of the rigor of the supervision process. So obviously in the first year of supervision, there will be a learning curve on both sides of the reporting process, and this will have an impact on the extent to which supervision is a tool to help build capacities rather than solely one to maybe identify and sanction infringements and all misleading information. So to illustrate maybe, under the existing guidelines, risk-based supervision relies on multiple factors that may signal a risk of infringements in an issuer's annual financial report. So typically the presence of any qualification in an auditor's opinion raises a red flag. That suggests that an enforcer may need to look into that report. So if we're sort of applying the same type of approach, that would mean that for sustainability reporting supervision, that same reasoning will apply. However, we should also consider that if following a qualification, a material infringement results in a formal action by an enforcer, the choice of the type of action will depend on the severity of the infringement and on the consideration of what is the best way to make up for it. So, for example, it's often the case that the issuer is requested to make corrections in future annual financial reports, or that it issues a corrective note. It's very less frequent that an issuer is required to reissue the entire set of financial or sustainability information. So when a formal action is not triggered, though, enforcers would still often enter into a dialogue with the concerned issuer to understand the reason for the infringement and agree on the most suitable way forward to ensure that the issuer makes up for any incorrect or incomplete information. So I'd personally expect that the dialogue mode here is the most helpful where possible, especially in the first years of application. So if the presence of a qualified audit report is likely to trigger an enforcement action, we should also be clear that the absence of a qualification does not automatically prove that there's no risk of an infringement. So here I'm coming to a different aspect. In fact, in a limited assurance engagement environment, as foreseen by the CSRD for the initial years, the risk of material infringements that are not necessarily detected during the assurance engagement is actually higher than in a reasonable insurance engagement. So your role as an auditor is slightly different. Our role as enforcers is still the same. So we have to also weigh that difference in our risk-based approach. So we have to be even more attentive when considering possible risk factors. So it doesn't imply, however, that supervisors are expected to rerun or second guess the work of the auditors or independent insurance providers. Certainly we don't do that. So I'd also like to be cautious that we wouldn't necessarily, and here maybe I'm also cautiously optimistic, as I was saying earlier, that we're not necessarily expecting a massive amount of qualified audit opinions because the Commission's delegated act envisages rather generous phase-in requirements. The entities that are first in line to report under TSRD are the largest, the most equipped entities, which already have experience in reporting, so under the NFRD. So if the necessary steps are taken to start the implementation projects as soon as possible, I think we can still be cautiously positive. And maybe obviously we all know that the journey of the international audit standards is starting, so we'll have to see where that lands. But it's obviously important also that the assurance procedures that are carried out by the various assurance providers sort of at some point all converge so that everything's done in a similar way.
Yeah. Thanks, Isabel. Just then, I'm going to ask Simon to be very brief in your reaction, right? But Simon, you hear Isabel saying cautiously optimistic still, that there may be
I like that from a supervisory organization. And we probably are not allowed to bet in this conference, but I would like to get a nice bottle of wine with Isabel that there will be quite some qualified opinions in the year to come, unfortunately, because yes, companies are experienced to some extent. But if you look at the listed companies on the AEX, the Amsterdam Stock Exchange, about 50% don't have any assurance on sustainability disclosures or ESG disclosures at this moment.
Yeah.
That is quite shocking. And then, you can say we only need limited assurance, so it's not so much work. But if you then again consider the number of data points that I just referred to, and I don't think we're an exception, it's massive basically. And you need so many people. You also pointed to the lack of staff, and the companies are poaching each other's staff already now. Marc is working at KPMG. They are hiring hundreds and hundreds of people. But they also need to retain those because companies like Philips will be maybe looking for a good internal controls person and hire that one from KPMG, for example. So it's simply, all coming together. It will be quite a challenge, I would say. But Marc, I'm of the opinion that there will be quite some qualified opinions. And it will also have, maybe that's a nice perspective as well, not talking only about listed companies, but for not listed companies, what will this mean to their financing? Because in many cases, their financing is subject to an unqualified opinion of the auditor, and that will not fly. And will they then be patient and do if ESMA is then supervising again banks, are they okay with banks granting loans to companies that have, qualified statements really? So it's a very, everybody's depending on each other, and what the future will bring, we'll see.
Yeah, and I think Isabel mentioned, a lot of dialogue is necessary between the various parties. That's at the level of maybe the entity, but also at the level of kind of the higher level of us as a profession, with the regulators, with the preparers, and standard setters actually to make this work. And I think, some of these risks I think they are real that we're alluding to. even if you're cautiously optimistic. But let me bring in Jeff and Kirsten again, because we're talking now about the challenges, and clearly, I mean, we're at the beginning of a journey. And I started with actually very positive, saying what had happened on the standard setting front is quite amazing in terms of how fast you've come to sets of standards of a high quality, on both sides. But now as the implementation process is starting, and again, maybe I start with Jeff. What do you think that standard setters can do to help the implementation process? And Kirsten, same question for you as well in a moment. Jeff?
Yeah, thanks, Marc. It's a great question. I think of this in really sort of two ways. One is what we're focused on, and the second is what we can actually then do in the standards and outside of the standards to support implementation or application of the guidance. So just starting with the focus of the ISSB, this investor focus, thinking through the lens of what we sometimes call financial materiality, that's actually that's going to make it easier for companies to comply with the guidance, because think of it this way: if a company if it has to file its taxes or has to file a regulatory, its financial statements with capital markets, if it has to do either of those tasks, those are big tasks. But if it has to do both, and most companies do, public companies do, then that's just more that they have to comply with. It's a broader mandate. And so I do think, because we are by mission focused on the needs of a narrower set of users of the information, investors, we can be a little more targeted. So that means that the things that we're trying to ask companies to disclose should be the sorts of things that are very closely related to core business activities. So that's, I think, one thing that does help. And the fact that we have developed and built off of, say, SASB's industry-based standards, this industry guidance also helps companies by, they can navigate and say, well, this is the main industry that I operate in, or these are the two or three where I reflect the core of my operations. And there's guidance there to help them already identify what it is. So, I think in some ways our focus and our use of industry guidance can help companies to implement the standards. And the other thing is that we're building off of well-known terminology and concepts. So the SASB standards have been around for 10 years. At least the process began about 10 years ago. TCFD has been around for a shorter amount of time, but again, very widely understood, and especially by larger companies. Some of the things that we're doing that we did inside of the standards were to build in concepts like expecting companies to use reasonable and supportable information that would be available without undue cost or effort. This is those that use the IASB's accounting standards are familiar with these types of concepts. And we also don't expect every company to come at some of the more complicated things like scenario analysis with the most sophisticated procedures right out of the gate. So we built into the standards an understanding that there's going to be a range of skills, capabilities, and resources that companies have. And so there's an expectation that you use the appropriate amount given your skills, capabilities, and resources, but also that it should be proportionate to the sort of risk or opportunity that you face as well. And so, again, if you don't have sort of an existential risk when it comes to your business and climate, then you still might find it important to disclose to investors, but you might not have to invest as much in managing that and disclosing around it if it isn't as big of an issue. So some of those concepts are built in. And then in addition to what's in the standards and the focus of the standards, we have developed guidance, sources of guidance, educational materials, and also have built in some transitional reliefs. So companies can start with climate, can start with, for example, scope 1 and 2, and then later on expand to beyond climate to all their sustainability-related risks and opportunities. And in the second year, for example, start to get to scope 3 if that's something that's material to their operations. So that's some of the ways that we're trying to deal with it. In addition to also partnering with regulators to make sure that we can help them as they kind of walk through what their expectations are going to be of the companies that operate in their jurisdictions.
Yeah, thanks, Jeff. That sounds like at least there is, quite a bit of thought being given to the transition. Kirsten, similar thoughts from a European perspective?
Yeah, of course. And Jeff already mentioned a lot of points. So, the question was, what can standard setters do to help the implementation process? I would say, well, write clear standards so that everybody understands what to do. And Simon and I, we did what we could, but now it's in the hand of the EU, and it might be some additional material needed. So, as Jeff already said, so we also provide guidance. What I think, and Jeff touched on that, is very important that we align in certain definitions. For example, if we talk about the financial materiality definition, it would be much easier for the implementation process if we have a common understanding of the financial materiality definition. And then, of course, we add on, Jeff, with the impact materiality, you only focus on investors. But don't obscure the investors, right? That was, I think that's what's in your standards. So first point is, clear standards, align as much as possible on definitions with the ISSB, especially when we talk about the global baseline. And as I said, so Marc, we are also focusing at EFRAG on guidance, especially on materiality analysis, because that is somehow the heart of every sustainability reporting. We also do guidance on the value chain, and of course, educate people, do outreach events, and give some interpretation of standards.
Okay, so let me then ask Simon. Simon, as you are on the receiving end, is that helpful from what you hear, and is there anything else that companies would be looking for to get in terms of implementation support?
So what Jeff and Kirsten said was completely valid. And again, I would like to make the difference between listed companies, the larger companies, and there are some not listed companies that are quite advanced, but not too many, and the other 49,000 companies in Europe alone. So if you put yourself in the position of a company employing 500 people that may have an administration of 4 to 5 people, and suddenly they need to report on 600 data points, they don't know where to start really. And also you can even question yourself: is this reasonable to act or to expect from a company of that size? Now, we're not going to debate all of that, but let's position ourselves in for example, the CEO or the CFO of that company that needs to manage all of this. What they need is really clear and simple guidance that is also not too extensive, because standard setters sometimes also have the tendency to write long standards, but also implementation guidance. And if you have 500 companies, 500 employees, getting an instruction on how to do a double materiality analysis, and the document alone is already 50 pages. You really turn people down, you confuse them. And then if you write it in a very academic way as well, which I hope will not happen, you don't really help those people too much. So what you need is, put yourself in the position of those people that need to do all of the work. And what do they need to have is first, an explanation. What is a double materiality assessment? Secondly, why do I need to do it? Well, because it's in the standard, and if you want to comply with the standard, you need to follow it. And third, tell the people in 5-6 steps what they need to do. And then they can get going, and then they start to get the feel of that, and then you can still have more detailed questions and specific answers to maybe academic positions that there could be, but that is not what the majority of the people are waiting for. The same goes for the value chain. There again, it needs to be understandable by those 49,000 companies, of which the vast majority have never reported on any ESG item at all at this moment. So we really need to take those companies by the hand. There should be tooling as well, and we need to be careful not to create, and you may hate me for saying this, Marc, that this will be a bonanza for the consultants, because that is what it seems to be to some extent, because many companies don't have a clue. They go to an advisor, and the more complex the requirements are, the more money the advisors can make. So they're as simple as possible, especially in terms of implementation guidance.
No, you refer to me. I think it is important that we have standards that serve the public interest and nothing else. I think that would be my statement on that. No, thanks. That's helpful. And then maybe Isabel also to you, right? Because also you drive a certain behavior. So what kind of support can you give in the implementation as regulators?
So I think there's a couple of angles. So the first one is, in the work that EFRAG is doing, we're observers on the EFRAG technical expert group and the board. So we'll certainly play our role there when the discussion on the various pieces of guidance or the answers to questions come up. And we will obviously try and have it, yes, if we can, as simple as possible, as straightforward as possible. And I would think it also in a timely manner. So try to see how we can handle it that way. Otherwise, I think I was mentioning earlier our guidelines, and our guidelines on financial information, pretty much say how we're going to be working. And since the ambition is the same, maybe I can recall a little bit of what we do, and the role that we have being to foster a consistent application of corporate reporting requirements in the EU. And to start off, obviously ESMA does not have a direct supervision powers, so that rests with the individual national authorities. So what we do is we coordinate. So how we do that, the basis is basically the supervisory case discussions that we have. So we have specific criteria in the guideline where we ask our members to bring cases to the table to discuss, how do we apply and to agree. So this can happen in a enforcement phase, or it can be in a post-enforcement phase, depending. If there's sufficient consensus, because also the final decision does lie with the enforcer. What we do in the financial reporting domain is we publish extracts just to show these are topics, and usually when we pick those topics, it's also because they're important topics that we think we need to bring to the stakeholders' attention, and we don't publish that many. I think we've published, since 2007. I think we've published 200 out of maybe 2,000 cases that we've discussed in financial reporting. So it's not like there's going to be this whole set of guidance coming out of ESMA, because it's also not our role. To provide interpretation. What we also do is every year we publish enforcement priorities. We've already started doing that on sustainability information, where we say, we want a particular focus this year on this, so please be careful, this, that, and the other, and provide transparency. And when there's unclarity, please provide transparency on how you've come to what you come to. Please have usually disclosures that are not boilerplate, that are really specific to the entity. And once we have those enforcement priorities, actually what we do is that we actually report, because behind that there's a whole mechanism of selecting the issuers, agreeing on how many each country is going to be looking at, and then we ask them to report back, and we publish a report where we do make explain what the outcome is. So and then what we can also do is topical studies. Apart from that, I think, as I mentioned, we engage also with various stakeholders as needed on bilateral basis, but we also have consultative working groups with our standing committees. Our members also obviously interact in their own market, and as I said, when there's issues that are really significant, they bring them to the European table. And then, as I said, I think earlier, we need to privilege dialogue. I think in the first years, so that we we foster high quality reporting. So maybe here just to mention that in financial reporting, there's a limited number of jurisdictions actually in the EU who have a pre-clearance process by which an issuer comes already to the enforcer saying, I have this problem and there's no specific guidance I intend to. And so discuss how to account for it and get sort of some pre-clearance. Obviously that comes with certain responsibilities on both sides, but and it could also be burdensome, but we could borrow from that practice, somehow make it a bit looser, have a more informal exchange, and possibly, to see what are good and possibly less good reporting practices before they're finalised in a report. I think here we need to be a bit creative, also in how we support preparers as far as possible, without losing obviously our independence and the rigor that supervision requires. It's a difficult balance, but I think we can strive to reach it.
Yeah, good. We started off with some concerns. I think when I'm listening to all of this, then I think also this is a bit more positive, and there's enough that we can do in order to support. Nobody said it's easy, but at least there's there is support available. The last bit of our discussion here, I want to ask, I think a very basic question actually. So now we have all these standards, and we will get a lot of performance metrics. So I think both investors and also other stakeholders will get a lot of more information from companies. There will be more fixed targets and reporting on whether these targets are being met. So the question to you is, from the discussion that I am having with some of the corporates I'm working with, some say, okay, well, this is a huge compliance exercise, and this is just a costly exercise. Some others also more advanced say, I really want to make an effort of actually making sure that I can use this to make it meaningful and to incorporate it into my strategy, and to make sure that what I'm reporting is actually driving what we're doing in the business, and therefore meaningful. So let me ask every one of you actually, I think, would you agree with that ambition that you should actually be incorporating this in your strategy? And maybe Jeff, will start with you, right? And then ask others. And are we going to actually be able to do that with the standards that we have?
Yeah, it's a great question, Mark, and it sort of taps into one of my innate fears, actually. So it turns out my Myers-Briggs personality test, if you've done it, you can see your personality, but there's a version that shows you your own personal hell. And mine is that everyone that I care about needs help, but the advice that I give just makes things worse. And that really resonates as something that, especially as a standard setter, you want the guidance to actually help, right? And so this is, if it ends up being a bit of a compliance exercise, then there's a lot of cost for no real benefit, and it's a real concern. When I think about what we're doing at the ISSB, some of it is baked into the things that we're asking for. So, this idea of connected information, looking at governance, linking it to strategy, looking at performance metrics that relate back to that, asking for information to be disclosed at the same time as financial reports are produced, so that the information is available and is on point, at the time that decisions are being made. I think that's a lot of what we can do inside the standards to try to prevent it from being just a check the box type of mentality. But I think more fundamental than that is basically comes down to what I think of as like decision usefulness and proportionality. So what we're asking for has to be decision useful, even if it doesn't change the company's operations. If it informs the intended user so that they can change their behavior, that's still something that is, very important. And oftentimes then those consequences will be things that companies then want to manage, to make sure that they're attracting the type of capital, for example, that they're looking to be able to attract. So decision usefulness is fundamental. But even when it's decision useful, the ask in terms of what we're expecting from preparers has to be proportionate to the benefit that would be available to the user of the information, in our case, to the investor. And so, if we get the information we're asking for wrong, it's not decision useful, or if we just go too far in terms of like asking for something that's not proportionate to the benefit, then all of the connectivity that we ask for as well won't help that much, right? Because it's the wrong information. A company's not actually going to want to manage it. And so it'll be a compliance exercise, or if it's just too burdensome, they can't help but just do the bare minimum to get to a compliance. So that's how I think about it. But I'm hopeful that we haven't got there. But my deep-seated fear is that, oh God, what if we didn't get it quite right? So that's why we keep working for sure. But that's.
Thanks, Jeff. So now your personality analysis, Kirsten. Do you have that similar fear, or if you look at a bit more focus on the European?
Well, we have a little bit of a broader scope. I said that already, and it shouldn't be, as Jeff already mentioned, it shouldn't be a compliance exercise. It should be much more, and that's what we are focusing on with our ESRS. So incorporated in the strategy is if I look back to the structure, it's the second point, right? Governance strategy. If I go down the TCFD, and I'm quite sure, Marc, if companies only do the compliance exercise, I'm hoping that it could be identified. I'm quite sure we can identify it from our scientific perspective, Jeff. So there will be much research coming up on that. I'm quite sure you can identify companies that only check the box, or that maybe also goes then into direction greenwashing, and we will do that at least from the scientific perspective. And as said, I hope it will not be the case. So that's why we worked very hard over the course of the last year on our ESRS.
Okay, thank you, Kirsten. Simon, I'll ask you as maybe as the last one, and because we have limited time left, but do you think that you can, as Philips, incorporate this and use this, to communicate your strategy and not make it a pure compliance?
Well, we already do. So therefore, I'm responsible for the implementation within Philips, and it's a massive exercise. We've got more than 60 people engaged with the implementation, not full time, but from very different disciplines, legal, audit, finance, but also design and all kind of other people. And then we, and that's not Simon saying this, but our CEO said, we cannot excel on 950 data points. That's impossible. And you shouldn't also, because you're spread too thin for that. But you can define where you want to be, the benchmark for your industry. And that is what we're going after. And for the rest, it will be a mix of compliance versus being the best in class. We do that also because we intrinsically have gotten belief in this. We've been reporting for 15 years in an integrated way, but also more and more we see our customers asking for this. There are tender questions out there. And if you can then be the best, you win business basically. And that is a great driver for change within the organization as well.
Exactly. Thank you. I think we're getting to the end of our panel, and there's so many more questions that I could have asked you, but we won't have the time for. So I think it's time to start wrapping this up. Any final thoughts from anyone of things that we haven't actually discussed that anyone wants to bring before we summarize and close?
Maybe Marc, when I talk to an audience on the CSRD and the ESRS, and apologies, Jeff, not really yet on ISSB, but what I always say, there's an enormous amount of work coming your way. You can use this to your benefit and position yourself vis-a-vis your competition. But it's a lot of work, and please start as soon as possible. Start with your double materiality assessment, because that is driving your disclosures. And if you haven't even done that, you don't even know whether you're talking about 400, 500 or 900 data points that you need to uncover. So really start as soon as possible. Also, if you're in the next wave or maybe in 2027, time is flying basically. And many companies don't even have the systems to capture data.
Yeah. Well, I think that's great advice, and actually very consistent with the advice that we're giving as well, Simon. Just get started, right? I think in order to be ready, because time is of the essence. So,
if I may also, just
Isabel, go ahead.
Be transparent about what you're doing and what you're presenting, what you're disclosing. It would be my message. As Simon said, you might not get everything right, or you might not be best in class for everything, but be transparent about what you're doing, also with the mindset that otherwise you might be engaging into greenwashing.
Yeah. I think, and again, also that is very good advice. And Isabel, actually, I hope that we see many companies actually, even before it's necessary in 2023 now, so over the current year, already starting to discuss where they are in their progress, and then going, forward also when they have to adopt to explain where they are and where they struggle, right? And that's the plea that you're making. And I think, just being transparent to the market is going to be very important. So thank you very much. So we discussed a lot. I think, yes, we see the challenges, but on the other hand, this is a sea change for the world. I've called it transformative in many ways. I also think it's transformative also, for the data that's going to be available. It's going to be transformative, hopefully, also in how we achieve the targets that the world needs in terms of climate and other objectives that we have. Transformative for the assurance profession. We'll also have to step up and, as many other financial professionals, start adding also knowledge on sustainability in addition to the knowledge of the finance. So there are challenges, but on the other hand, great opportunities to make this work, and that's what we covered today. So I'm going to thank all of you very much for your contributions. I thought it was a very lively debate. I hope our audience agrees with that. So thank you very much, and we close with this. Thanks a lot.